looking at what you've been writing over the last couple of days, it seems as if you maybe think that markets aren't reacting quickly enough to the developments in the Middle East. In which assets do you see that most notably, Mark? Is that a stock story? Is it oil?
It's not so much the speed of reaction, it's kind of the delayed attitude is very complacent. I think that over the weekend, what we saw was a game-changing event. I'm always in favour of not being too knee-jerk. Monday's price action didn't surprise me too much, but as we've had time to process it, it is fair to acknowledge that almost nobody I spoke to expected the Iran situation to be like this week. They did not expect the scale of attacks. They did not expect the scale of retaliation from Iran on all its neighbourhood. They did not expect the disruption we've seen to the Strait of Hormuz. So everything we've seen is game-changing. Now, some people may dismiss it as oh, it's only temporary, but people aren't yet acknowledging that, we've had a major event happening and we are seeing an energy price shock. Some people, I'm glad to see, Will is very much my camp there, talking about the energy price shock, talking about the supply chain shock. But many people yesterday were dismissing about, the one-day move is irrelevant, it's only 8%, that's not a big factor. That ignores the fact that Friday close was the highest close since July last year. We are already trading, before the weekend, 10% above the average of the last year, almost 10% above the average last year in Brent crude. We're now 20% above the average of the last year. Gas prices are more than 50%. UK gas prices are something like 70% above the average of last year. We're having an energy shock. Yes, we can debate about what extent, how long it extends, but we've got an energy price shock. We've got a supply chain shock. We're therefore going to get higher yields because we've got an inflation impulse coming through, and that's not good for what we're happening in the credit sector. So consumer sentiment is going to get hurt by wealth effect, by higher prices, by higher yields, and just generally they're seeing images of war on their front pages around the world. So I think equities will reprice significantly lower over the coming weeks.
Yeah, and we're certainly starting to see that in the Asian session today, aren't we, with some really heavy selling across the benchmark, but also in places like Korea. Mark, do you think we rewrite the playbook then for central banks as well this year on the back of what we're seeing in the Middle East?
Look, I mean, the Fed was the main one in trying to push through easing, and many people in the market were already cynical about that. I do think it's going to make it more complicated for central banks. I think the Fed is still going to be under pressure to cut, given half a chance, which is going to be complicated. But yes, I mean, look, I think we're getting some sort of inflationary impulse here. In a world where yields had dropped a long way, and that's, I think, part of the problem here, is the positioning was not ready for this. We had seen dollar softer, and the dollar is the ultimate haven from this asset. We'd seen yields much lower, and we'd seen the main stock markets gain be those Asian equity markets that are of major energy importers, things like Korea, Japan, China. So I really think the market is not positioning this for all. Now, I'm not expecting a shock move, but I just think that the risk aversion is going to gradually deepen over the next coming weeks. And I think we're going to see a much larger sell-off. And yes, that will mean yields higher as well, but a bit more mixed.